Welcome to NRI Tax Show powered by IndianCPA.com.
In this session, we're going to look at how much more would I be paying in taxes this year. So this is a common question I get. Folks do understand there has been some changes in the legislation which would impact them in terms of the taxes what they pay. So we will take a closer look at what changes have been made and how that would impact you. Here's a quick disclaimer. I would appreciate if you could pause the video for a moment to go through this disclaimer here before we get started. The agenda for today is taking a quick look at the new legislation, a quick snapshot of all the changes, marginal tax bracket, so what that means to you, Medicare and net investment income tax, so that's something new which we're going to look at as well. The new legislation impacting 2013 year are American Taxpayer Relief Act 2012 and Patient Protection and Affordable Care Act, commonly known as Obamacare. Here's a quick snapshot of the changes between 2012 and 2013. We have all the key tax changes on the left column here, and then we have a comparison between 2012 and 2013 year to make it as simple as possible. So the top tax rates have gone up from 35% to 39.6%. So we would look at, when we look at the marginal tax bracket, so who are the folks who are impacted with the 39.6% tax rate. Long-term capital gains and qualified dividend tax rates. So there used to be a 0% and 15% tax rates for capital gains and dividend rates, and 0% was for taxpayers who were between 10 to 15% tax bracket, or for the 10% and the 15% tax brackets, and 15% for 25% to 35% tax bracket taxpayers. Now, for the year 2013, we also see the 20%, which is applicable for the folks who are on 39.6% tax bracket. Itemized deduction and personal exemption phase out. So if you were to earn too much, according to IRS, then you would be subject to a phase out of your itemized deduction and personal exemption. So if you were to earn $200,000 or more as in single, or $300,000 or more married filing jointly, then your itemized deduction and personal exemptions would be reduced using a certain formula. So I'm not going to get into the details as to how exactly it would work in terms of how it is reduced, but please do understand there is a reduction in the itemized deduction and personal exemptions if it's subject to these income levels. Medicare tax on wages, net investment income tax. So again, if you were a high income earner, so that is $250,000 for single, and $250,000 or more for married filing jointly, then you would be subject to Medicare tax rate at 0.9% and net investment income tax rate, which is at 3.8%. Medical expense itemized deduction. So as you're aware, you could take medical expense deduction on your itemized deduction, which is Schedule A, if your medical expenses were to be beyond 7.5% of your adjusted gross income, and that rate has been increased to 10%. So it's going to be really hard to get a medical expense deduction unless you have one substantial, which is more than 10% of your adjusted gross income for the year 2013. Estate, gift, and generation skipping tax exclusion. So it used to be at 5.12 million, and it has been there hasn't been a major change. It's 5.25 million for the year 2013. However, there's a major change in the tax rate for estate taxes, which has jumped from 35% to 40% for the year 2013. Annual gift tax exclusion. So it used to be at $13,000 and now it has been increased to $14,000. So what that means is if you were to give a gift to someone which is less than $14,000, you are excluded from filing a gift tax return or paying any taxes. If you were to be beyond the $14,000, then you're subject to filing a gift tax return. So this is something very important. Usually, taxpayers miss this piece. They would transfer funds to their friends, families, and which would exceed the $14,000. So if that is the case, you are subject to filing a gift tax return. I wouldn't go too much into the detail here on estate and gift tax. We would cover that in a separate session. Marginal tax bracket. So what does marginal tax bracket mean? So that's the tax rate on the last dollar what you earn. So that means is, so if you were to earn $150,000, so the last dollar what you earn is subject to 28% tax rate. So any income below that $150,000 would be subject to various other income tax rates, which starts from 10%. So there's 10%, 15%, 25%. And so when you have to calculate, so you would see, if you had $150,000 in income, so the income between $146,400 to $150,000 would be taxed at the 28% rate. The income between $72,500 and $146,000 would be taxed at 25% tax rate. And of course, these income is considering your personal exemptions, your standard or itemized deduction. So this is the taxable income we're talking about here. So you see here the 39.6%, which is something new for the year 2013, and that's subject to folks who earn $450,000 or more if they're filing jointly, or $400,000 or more if they're filing as single. Medicare tax and investment income tax rate. And the Medicare tax is at 0.9%. And this is going to be on top of what you already pay, and that's for folks who fall into the high income taxpayers. This is according to IRS. And if it's single and if you earn more than $200,000, then you fall into the high income taxpayers category. And if you're $250,000 or more and filing a joint return, you fall into the high income, taxpayers category. So for these folks, then, they pay an additional 0.9% taxes on the wages as well as the self-employment income. The 3.8% net investment income tax is subject again for the people who are considered as high-income taxpayers. We'll take a closer look at what investment income means and who are subject to 3.8%. So as far as who are concerned, we know that it's high-income taxpayers falling into these category here. Now we'll look at what net investment income means. So net investment income includes taxable interest, dividends, capital gains, annuity income, income from passive activities. So this investment income, technically, if you take, for example, the capital gains, so that would be taxed at either the 0%, 15%, or the 20% as per the new rate. And now, if you're subject to this net investment income, based on your income levels, you would be paying an additional 3.8% on top of whatever you pay, which is 15-20%. So if somebody were to be at the 39.6% tax bracket and they pay a 20% capital gains tax, they would now be paying 20% plus the 3.8, which is 23.8. And if someone was at 15%, they'd be paying 18.8%. Hope that clarifies. If you have any questions on these, do email us and we will try to touch base with you to provide you additional information. Thank you, and would appreciate if you could take a moment, subscribe to our YouTube channel, and like us on Facebook, which is at facebook.com/NRI Tax. You could also opt into our mailing list, and we would be sending you all the important updates, and that's at IndianCPA.com. Thank you.